Okay, let's dive right in. Something big is happening in the world of startup investing, and it's creating what might be one of the most interesting and, yeah, one of the most dangerous opportunities for investors looking ahead to 2026. We're talking about a whole new way to get a piece of the action from the biggest, most disruptive private companies out there. You know, the OpenAIs, the SpaceXs, long before they even think about hitting the public stock market. Now, this quote right here, this is the whole game we're unpacking today. This isn't your granddad's venture capital, the stuff reserved for a few elite firms in Silicon Valley. This is about a new frontier, the secondary market, where the early employees who built these unicorns are finally looking to cash out, and a whole new wave of investors are trying to get in. But before we get into the how, you first have to understand the absolutely mind-boggling scale of the wealth that's currently locked up. To get a sense of just how big we're talking, just look at this number. By the end of summer 2025, OpenAI's annualized revenue had reportedly skyrocketed to $13 billion. Companies like this have generated world-changing wealth. But here's the crazy part. For thousands of the actual people who built these companies, the engineers, the marketers, the project managers, that wealth is basically an illusion. It's just a number on a screen, a number they can't actually touch or spend. And that leads us right to the core problem that's fueling this whole new market. It's a classic situation called the golden handcuffs. Just imagine for a second, you're an early engineer at some hot AI company. Your stock options are worth, say, $5 million bucks. On paper, you're a millionaire. But in reality, you might be struggling to even make a down payment on a house. You've got this immense wealth, but absolutely zero cash. You are, quite literally, rich on paper, but broke in real life. Now, for decades, there was a pretty simple way out of this trap. The IPO, the initial public offering. That's the big day a private company goes public on an exchange like the NASDAQ. It's the moment all that paper wealth finally turns into real, spendable cash for employees. But that escape hatch, well, right now, it's pretty much frozen solid. So the big question is, why has this critical path to getting paid become a dead end? Well, the reasons are global and they've been piling up. It really kicked off with massive geopolitical shocks, like the war in Ukraine, which just injected a huge dose of uncertainty into the markets. Then you layer on top of that the growing tensions around China and Taiwan, which spooked investors even more. So what's the result? The people running these huge private companies, the founders, the board, the big VCs, they're all hitting the brakes on going public. They're looking at the stock market and thinking, nope, prices are too low, we're not going to get the valuation we deserve, so they're choosing to just wait it out. And here's the thing, a multi-billion-dollar company can afford to wait for perfect market conditions. But a lot of its employees, they can't. They have real lives. They want to buy a house, pay for college, or maybe they have a sudden family emergency. Their single biggest asset is completely locked up and they can't get to it. This has created this enormous pent-up demand for cash. And you know how it goes in finance. Wherever there is that much demand, a new market will eventually pop up to meet it. And that brings us from the problem to the solution that is seriously changing how people invest in the world's most promising companies. And that solution is what's known as the secondary market. So what exactly is the secondary market? Put simply, it's a marketplace where you can buy and sell shares of private companies. It's not the New York Stock Exchange. Think of it more like an exclusive eBay for assets that aren't available to the public. And it's called secondary because you're not buying shares directly from the company itself, like in an IPO. Instead, you're buying them from a secondary source, an existing shareholder like an employee who wants to cash out. Now, what's really interesting here is how simple the process looks on the surface. Let's just walk through it. An employee at, let's say, Anthropic needs to unlock some of their equity. They go to a platform, something like Forge Global or Hive, and they list a block of their shares for sale. On the other side, you have accredited investors, people who meet certain income requirements, who can see these listings and place bids. A price gets negotiated, the deal is done, and boom, the employee gets the cash they needed. On the surface, this looks like a perfect win-win. The employee who is trapped by their golden handcuffs finally gets an escape hatch. And an outside investor gets this rare chance to own a piece of a top-tier private company years before it might go public. It seems perfect, and trust me, this is a huge but. The devil is buried deep, deep in the details. What you're buying on this market is not always what you think it is. Okay, this brings us to the most critical technical piece of this entire thing. Seriously, if you take only one thing away today, make it this. Because not understanding this one difference can be the decider between a fantastic investment and losing every single penny you put in.
The question sounds so simple, right? But the answer is incredibly important. Yeah, you're buying stock. You're buying a piece of a company. But there are different classes of stock, and the class you own determines your rights, your protections, and most importantly, where you stand in line when the money is handed out. See, most employees are selling one kind of stock, while the big VCs are holding a completely different and way more powerful kind.
All right, here's the crucial difference. The big money venture capital firms, they hold something called preferred stock. The key word there is preferred. It means they have special rights. Chief among them is something called a liquidation preference. It's a fancy term that just means they have a contractual right to get their money back first if the company gets sold or goes bust. Employees and founders, on the other hand, hold common stock. This is almost always what you're buying on secondary markets. And common stockholders, they are dead last in line to get paid. So you have to think of it like this. There's a pecking order for who gets paid. If a company goes under or gets sold for parts, the very first people to get their money back are the debt holders, so the banks. After they're made whole, the next in line are the preferred shareholders, the VCs. And only if there's a single dollar left after all of those groups have been paid in full do the common shareholders, the people who bought shares from employees, get anything. And this quote says it all perfectly. In a bankruptcy, common stock pretty much always goes to zero. But here's the part that trips a lot of people up. This isn't just about bankruptcy. Imagine a company raised $200 million from VCs. A few years later, it gets sold for $150 million. Sounds okay, right? Wrong. If those VCs had a liquidation preference covering their $200 million investment, they get all $150 million from the sale and the common stockholders get nothing. Not a dime. The company sold for a fortune and your shares are still worthless. Okay, so now that we understand the very specific, high-risk thing we're buying, let's look at the other brutal truths of being an investor here. Because getting your money in is one thing. Getting it out is a completely different and sometimes impossible story. 5 to 7 years, just let that sink in for a second. That's how long you need to be prepared to have your money locked up. When you buy shares in a private company, there's no open market. There's no sell button you can just click. You could be stuck in this investment for 5, 7, maybe even 10 years until the company maybe goes public. In investing, this is the very definition of an illiquid asset. You can't easily turn it back into cash. And hey, this is not a hypothetical risk. This is a direct quote from the terms for Robinhood's private open AI fund. It says right there, black and white, that investors cannot sell or transfer their shares. They are completely at the mercy of the platform to decide if and when they will ever be allowed to sell. You don't control your own money. The platform does. Period. Let's make this really personal. Imagine you invest, say, $50,000 into a promising private company. 2 years later, a loved one has a medical emergency, and you desperately need that cash back. Tough luck. Unlike a public stock you can sell in seconds, your private shares are locked away. You're sitting on a potential fortune, but you can't access a dime of it when you actually need it most. It's the investor's version of the golden handcuffs. So on top of the stock risk and the liquidity risk, there's a third monster, valuation risk. And history gives us a pretty scary lesson here. If you look at private investment in tech as a percentage of the entire economy, we are now back at the exact same euphoric levels we saw at the absolute peak of the dot-com bubble in 2000. That's not just driven by solid fundamentals, that's driven by hype. That's fear of missing out. And this is the brutal truth every investor needs to remember. The internet was, without a doubt, a world-changing technology. But being right about the tech did not mean you made money. The Nasdaq collapsed by nearly 80%. Thousands of promising startups, Pets.com, Webvan, went straight to zero. A revolutionary technology can, and often does, create a devastating investment bubble. AI is revolutionary, but that does not make every AI company a guaranteed win. So after all that, the opportunity, the mechanics, the huge risks, what does the playbook for an informed investor actually look like in 2026? How do you navigate this new world where the lines between public and private markets are just blurring like crazy? All right, let's boil it all down. First, yes, the secondary market is a legitimate new way to potentially get into generation-defining companies early. Second, you have got to do your homework and understand what you are buying. Know the difference between common and preferred stock. Third, you must be prepared for extreme illiquidity. This cannot be money you might need next year. And finally, be deeply, deeply skeptical of private valuations. We are in a historic hype cycle, and history shows these cycles can end very badly. And all of this leaves us with one last critical question. The fans of this will tell you it's the democratization of finance, an amazing chance for regular investors to get into deals once reserved for the elite. But the critics will warn you that it's just a new trap, a way for insiders to dump their riskiest assets on less informed buyers at the top of a bubble. The truth is, it's probably both. It's an unprecedented opportunity, and it's an incredibly dangerous trap. The question you have to ask yourself is, are you knowledgeable enough to tell the difference?